minus 23,000. That is not a forecast that got shaded lower or a soft month that came in a little light. That is the count of jobs the economy did not add last month. It lost them when the crowd was looking for a gain near 80,000. And the 2 months before it were quietly cut by another 103,000 on top. This is the Algo Index market close for Friday, the 7th of August. On paper, a labor market that is shrinking is the sort of headline that opens a growth scare. Today, it did the reverse. The S&P went out at a fresh record high, 77.58, higher by about 0.6%, and it closed the book on its strongest week since April. Hold one thread as we go, because it decides next week. The cheapest thing in this whole market right now is the insurance against it, and a wall of events is waiting just 3 sessions out. So the work tonight is to explain a single contradiction, the worst payrolls print of the cycle, and a record close landing on the same afternoon. The bridge between them is not mood or momentum. It is the path of interest rates. And once you see how the money actually moved, you will also see why the safest trade into next week is the one sitting on sale. Take the closing board first. The S&P settled at 77.57 and change, up 0.62%, a record close. The Nasdaq 100 did the heavy lifting, higher by 1 2/10, roughly double the broad index, because falling yields reward the longest duration growth names before anything else. The fear gauge eased about 1.5% to just under 15, while its companion measure of expected future swings ticked up to 90, a quiet little disagreement inside the volatility complex worth filing away. The full high-to-low span was 57 basis points, and 1-month protection now sits near the 13th percentile against its own year, which is another way of saying dirt cheap. Under a calm, green record close, the jobs market just went into reverse. Begin with the mechanism, because the whole record was built out of one repricing. A weak jobs number does one clean thing. It takes a near-term rate hike off the board. The money markets that had been toying with a move this autumn shoved the next possible hike out toward December. The 10-year yield slid to about 4 2/3%, the dollar gave ground, and every asset that resents high rates caught a bid at the same instant. Stocks and gold side by side. Now the piece that does not sit anywhere on your screen. The S&P options market finished with roughly $2 billion of net customer positioning, a blend of call buying and put selling. And the plain read of it is that index hedging demand was thin and nearly all of the activity was same-day tactical trading rather than fresh conviction being stacked on for the move higher. The record, in other words, was not a stampede. It was a market with the brakes released, letting a rate relief bid carry it upward. Here is the part to keep. The 1-month gauge of whether stocks move as a herd jumped 12% on the day, and even after that leap it closed at 7. Still under the 8 mark that our afternoon options read flags as the point to start buying protection. So on the very afternoon the index printed a record. The deeper positioning slid back into the zone that says insure this thing. And the gamma structure underneath, positive below the close and negative above it, is precisely the shape that buys the morning dip and then lets the upside run, which is exactly the session the day delivered. Look at the real 5-minute session, because it behaved with discipline. Price opened near 77.35, and the jobs number did put a dip in first, down to 77.19 by 10:15. That low is the whole tell. It stopped a shade above 7,700, the shelf where the next session options pin lives, and buyers took the wheel from there. Off that low, the index worked up to its high of 77.63 just before noon, and then held the gain into the bell. Notice what did not happen though. The high stalled about 30 points short of the all-time intraday high at 77.93 from 2 days ago. So what we got was a record close without a new record high. The clean map into Monday reads like this. 7,700 is the pin and the shelf beneath. 77.46 is the computed pivot, sitting right under price. And 77.74, then 77.93 are the resistance steps stacked overhead. The most shareable ticket today is not in the S&P at all. It is in gold. The single largest premium order in the whole flow was 56,000 September call spreads on the gold fund, the 410 to 430 strikes, a dated, sized, one-directional bet, and it paid in the same afternoon it printed, as gold broke out more than 2% and the fund followed it up. Right alongside it, 18,000 September risk reversals on the gold miners fund, and the miners ran about 7%. The message is simple enough to keep. When a weak jobs number tells you rate cuts are coming closer, the fastest money does not only buy the index, it buys the metal. And today it did both, with both hands. A single fact on protection before we turn the corner to next week, and I am aiming this one straight at you. At the money, volatility priced for Monday is about 7%, and 1 month realized volatility has been running near 14. That is protection selling for roughly half of what the market has actually been moving. It is not a nudge to do anything. It is a fact to carry if you want to define your downside into next week. You are being handed the cover at a discount. The desk itself ran it straight today. We graded the session arranged before 10 in the morning. None of our 4 trend day tests were met, so we worked deep resting orders at mapped structure instead of chasing green candles up the screen. The scorecard, on the only frame that counts, the actual option premium, was 2 small winners against 2 small losers, and the book went home flat. The winners were the dip bought right at the deep support stack on the session low, and a fade of the supply shelf on its third failed push into it. The losers were a long off the reclaimed band that we cut the moment the flow that justified it flipped negative, and an automated index short that went offside early, which we flagged to members in real time as it was happening, and which then ran to its afternoon exit. 2 and 2, no dressing it up, and going home flat into a weekend was the right book to hold. Now, the week in front of us, and tonight this is the segment that earns the extra minute, because the forward setup is the real story. Start with Monday itself. There is not one United States economic release on the calendar. No data, no reporters of any size. An empty session like that usually drifts, and the single gravitational pull on the map is the options pin at 7,700, about 57 points beneath the close, a gentle tug lower rather than a shove. But look one step past Monday, and the calendar gets crowded in a hurry. The consumer inflation print lands Wednesday, producer prices Thursday, monthly expiration the week after, and then the session that follows the largest chipmaker's earnings at the end of the month. 4 events, back to back to back. And here is the tension that defines the stretch. The options market is pricing Monday at roughly 0.7%, and pricing the days beyond it barely richer. Even as our end-of-day read openly warns that the term structure looks too cheap against every one of those catalysts. You have the calmest, cheapest volatility of the season parked directly in front of the busiest run of the month. Let me score last night out loud, because this desk grades its own calls. From this seat yesterday, we framed the setup as cheap downside cover heading into the jobs gate, a market leaning a touch lower into the number. The number came, it came weak, and the direction that actually paid was up, a record close. The cover we flagged expired into a rally, not a sell-off. That is worth saying flat out, rather than sliding past it. And here is the thing, today does not settle, so I will not pretend it does. A labor market that is genuinely contracting is either a gift, because it forces easier policy, or the first crack, because jobs lead everything else down. The market voted gift today. That is a wager it placed, not a fact it proved. And Wednesday's inflation number is the first real audit of it. So the read into Monday is constructive, with a preference to buy dips rather than to chase the record. Medium conviction, dealer positioning supportive beneath price, and the pin a modest drag below. What flips it? Lose the risk pivot near 76.80, and the constructive read is gone. And if you intend to own the coming events, the volatility to own them with is on sale tonight. 2 destinations and 1 room, then I will set you free for the weekend. The Algo Index Trading Journal is free to open for anyone over at members.algoindex.com/auth/signup. And every setup you record there is scored against the exact price your screen showed the second you committed to it. Whether these dealer levels actually did their job, win or lose, stays posted in the open at algoindex.com/tools/gamma level accuracy. The written version of everything tonight is up at algoindex.com/blog. And the people who argue every one of these calls out loud in real time are over on Discord. Enjoy the weekend. Keep an eye on Wednesday's inflation print, and I will be back with you Monday night.